Simon says subscribe and click on the bell icon to receive notifications.
Hello and welcome. Part 1 of our forecasting working capital discussion in our financial forecasting in Excel course. For this module, I suggest you keep the formulas we had discussed when planning our forecasting game plan handy. This will ensure you are able to follow the calculations. Let's move to our Excel file to discuss the steps necessary to forecast the working capital of ABC. Before we start our forecast for working capital, let me explain what working capital actually is. Working capital is defined as the difference between the company's current assets and its current liabilities. In order to forecast the current assets and the current liabilities for the future time periods, we need to calculate the changes in net working capital. To calculate the change in net working capital for ABC, we have to determine the difference between the current assets and the current liabilities in the different accounting periods. Now that we know what working capital really is, let's move to our working capital tab to forecast the current assets and liabilities for ABC. This is our working capital tab. Before we start working on this tab, let me share a little tip with you. I find it very useful to use different colors to ensure I understand where exactly the numbers are coming from. I suggest we use the color green to identify numbers coming from other tabs. Let's use black for numbers that we will calculate on this tab. And let's use the color blue to isolate the assumptions that we will be using. Starting from the top, we have the net sales and the cost of sales. And these need to be linked directly from the income statement. Let's start off by linking these two line items. So these are the linked figures. Let's have a look at the working capital balances line items. As you may know, current assets include cash and cash equivalents as well. However, in this tab, we will just forecast the non-cash current assets. Cash and cash equivalents will be dealt with separately. Starting off with the non-cash current assets, let's start linking these figures from the balance sheet. Let's do the same with the non-debt current liabilities section. Unlike the net sales and the cost of sales that we had forecasted previously, we now need to forecast the non-cash current assets and the non-debt current liabilities in this tab. Let's first calculate the net working capital from 2016 to 2020 because we already have the non-cash current assets and the non-debt current liabilities. As you recall, the formula for net working capital is current assets minus current liabilities. So using that formula, we'll calculate the net working capital. We drag the formula across because the methodology is the same. Let's now calculate the increase or decrease in working capital starting from 2017. We will start from 2017 because we need this number from 2016 to calculate the change in working capital or the increase or decrease in working capital in 2017. Let's calculate it together. For 2017, it will be the net working capital in 2016 minus the net working capital in 2017. Let's drag the formula across. Calculating the purchases that ABC has made now. So purchases is simply the cost of sales plus the change in inventory. Let's calculate it for 2017. So we start with the cost of sales for 2017 and we add the inventories for 2017 and then we back out the inventory for 2016. We now have purchases from 17 through 20. In order to forecast the accounts receivable, the inventories, and the current assets for the future years, we need to make some assumptions. For accounts receivable, we need to determine what the average collection period is from 2016 to 2020, and then we can use that as a basis to forecast 2021 through 2025. For inventory, we need to understand for how long is the inventory outstanding, and for current assets, we can use the percentage of net sales as a basis. Similarly, for accounts payable, we will calculate the number of days payable from 2016 through 2020. For accrued income taxes, we will use the percentage of cost of goods sold or COGS assumption. And for other accruals, we will also use the percentage of cost of goods sold assumption. Again, the idea here is to use the historical information we have available to forecast for the future. For 2017, to calculate the accounts receivable collection period in days, we need to calculate the average accounts receivable for 2016 and 2017 and divide the net sales of 2017 by the average number. In the second step, we will divide 365 by this number. This will then give us the accounts receivable collection period in days. In case it's not clear, we are using 365 over here because we know that there are 365 days in a year, and in order to calculate the collection period in days, we need to use this figure. Let's discuss this part of the formula first. D6 is the net sales in 2017 divided by the average of receivables between 16 and 17. And then we divide 365, which is in cell C27, by this number. We drag this formula across. The average over the past 4 years is around 20, so we can use that number as the average accounts receivable collection period in days. These figures are in blue because we used an assumption to arrive at these figures. To calculate the inventory days outstanding, the formula is similar to the accounts receivable collection period formula. We just replace the net sales with the cost of sales. So let's discuss the formula. Starting off with this highlighted part of our formula. We start off with the cost of sales, which is in cell D7, and we divide it by the average inventory, and then we divide 365 by this number. For 2017, the average inventory days outstanding is 31. Let's drag the formula across. The average inventory days outstanding is 31, and we can use that number for the future periods. Other current assets is a relatively simple formula. We discussed that it's a percentage of net sales. So the formula is current sales divided by the net sales for the year. For 2017, it's 3826 divided by 145,588. The average other current assets are 2.9%. So let's use that number for the future periods. We now have all the information we need for our non-cash current assets forecast. That concludes the current module. In this module, we discussed what working capital really is. We also discussed the non-cash current assets ratios and assumptions. Remember, the key concept is that we calculate the historical financial ratios and we use these ratios for the future years. In the next module, you will see how we utilize these ratios for forecasting the line items. Hello and welcome. We will continue with our forecasting working capital discussion in our financial forecasting and Excel course. Like in the previous module, I suggest you keep the formulas we discussed when planning our forecasting game plan handy. This will ensure you are able to follow the calculations. We will now move to our Excel file to continue where we left off in the previous module. Let's now fill this section for non-debt current liabilities. The accounts payable days payable formula is very similar to the accounts receivable collection period and the inventory days outstanding formula we have discussed previously. For accounts payable, we will use the purchases that we calculated to arrive at the days payable. So we use the purchases in 2017. We divide it by the average of our accounts payable in 16 and 17. And then we will divide 365 by this number we calculate. We drag this formula across as the methodology is the same. So the average days payable is around 66. Let's use that for the future periods. For accrued income taxes, we will use the percentage of COGS or percentage of cost of goods sold, which is also known as the cost of sales. It's simply the accrued income taxes divided by the cost of sales. Our average accrued income taxes are around 15.5%. So let's use that number for the future periods. Other accruals is also the percentage of cost of sales. So we will use the accruals number for the year and divide it by the cost of sales. Again, we determine the average, which is around 2.8%. And we use that average for the future years. Now that we have these assumptions, let's forecast the future current assets and current liabilities for ABC. Previously, in order to calculate the numbers in blue, we had to use the historical numbers that we had available. Now, we have the ratios and we need to determine the forecasted numbers in the future periods. Let's take a look at an example. For receivables, we previously used the 365 days assumption, the net sales in the period, and the average receivables. In order to calculate the receivables, we have the collection period in days available. So let's look at the formula now. It's simply going to be 2 times the accounts receivable, because previously we were calculating the average, and then we multiply that number by the sales turnover, and we back out the receivable from the previous period. It's all about reorganizing the formula that we discussed earlier in order to forecast the current assets and the current liabilities. We have forecasted the receivables now. Let's apply the same approach to the inventories line. The formula is effectively the same. It's just that for inventories, we are using the cost of sales rather than the net sales. Other current assets was the percentage of net sales. So we use our current assets percentage and multiply it by the forecasted sales for 2021. So our non-cash current assets calculation is now complete. Let's take a look at the non-debt current liabilities over here. Before we forecast our current liabilities, we need to fill in the purchases section. We can fill in the purchases section because we have already forecasted the non-cash current assets section. So we just drag the formula across. Now let's forecast our current liabilities. The approach is essentially the same as the forecasting approach for current assets. We just need to rearrange the formulas we previously discussed to forecast the non-debt current liabilities line items. Starting off with the accounts payable. Let's discuss this formula in two segments. Let's first go through this part of the formula and we'll discuss the subtraction later. Firstly, we are trying to determine the number of years it takes for these purchases in 2021. So we are dividing the $110,311 of purchases in 21 by 365. And then in this segment of the formula, we are using the days payable average and multiplying it by 2. So this part of the formula helps us in calculating the total accounts payable, and we then subtract the accounts payable in 2020 to arrive at the accounts payable in 2021. Let's forecast the accrued income taxes, which was simply a percentage of the cost of sales. So for 2021, it's the cost of sales of 2021 times the accrued income taxes percentage be calculated over here. The accruals were also the percentage of cost of sales. So the formula is the percentage that we calculated times the cost of sales for the year. Let's add the non-debt current liabilities. Now we have forecasted the non-cash current assets and the non-debt current liabilities. We can fill in the net working capital and the increase decrease in working capital lines as well. As a last step, we can summarize the cash flow from the individual line items in the section highlighted over here. The idea here is to calculate the increase or decrease in working capital per line item. For example, in order to calculate the increase or decrease in receivables for 2017, we will use the receivables from December 2016 and subtract it from the receivables in December 2017. Let's drag this formula across for the future time periods. We apply the same approach to the other line items. Now that we have calculated the cash flow from these individual line items, let's add them all up to arrive at the net increase or decrease in working capital per year. We have now calculated the increase or decrease in working capital per year, and it's broken down by individual line items. That wraps up the current module. In this module, we discussed the ratios and assumptions for non-debt current liabilities. We also forecasted the line items for non-cash current assets and non-debt current liabilities using the historical ratios. As a last step, we calculated the cash flows from the individual line items as well. Hope to see you in the next module.
This video is part of our full course on financial forecasting and modeling. To take a look at the course, click over there. If you're not a subscriber, click down below to subscribe so you get notified about similar videos we upload. And to see similar videos, Click over there.